Hi, this is Ankur. In this video, we'll talk about the impact of the interest rate cycle, especially in today's context where RBI has taken a stand of increasing the interest rate, which was dependent upon the inflation in the economy, and inflation is showing signs of increasing at a rapid pace. What does all this mean for your portfolio? Interestingly, markets always indicate that nothing is permanent. If you are at a lower end, it will rise, and when you rise, you fall. And that is the case with interest rate cycles also. So, first of all, before I start, I would like to mention one very important book on this subject, which will give you a very deep understanding of interest rate cycles, market cycles. That is a book by Howard Marks. So this is the book that will give you a very good understanding of interest rate cycle. But in a very simple terms, let's reflect on the learnings from this book in the context we are in now. So first of all, let's reflect the interest rate cycle. What really causes the interest rate cycles? Well, first of all, there are two forms of cycles. One is a long-term cycle. The other is a short-term cycle. Short-term cycle would be anywhere between 7 to 8 years, and long-term would be anywhere between 80 to 100 years. Honestly speaking, I don't have an expertise to reflect on 80 to 100 year cycle as of now. But what I see is 7 to 8 year cycle, we have a fair sense of how that evolves. And this 7 to 8 year cycle is also called business cycle. It can be called as market cycle. So let's understand where we are and where we are heading. So this is a chart, as you can see, is RBI repo rate chart. Well, towards the end, somewhere on this side, there is an increase by 40 pips very recently, last week only. So this has started increasing. But even with that increase, we are still at the lowest spectrum of interest rates in our history. So what does this mean? This basically means that there is a lot of leg room by the central bank to increase the interest rates. So let's reflect why all this happens. So think in a very layperson's term. Whenever interest rates are low, you want to buy more, you want to spend more. People tend to buy cars, people tend to buy houses, and so on. So in a way, what we are trying to say is there is a certain stimulation that happens when the interest rates are low. Similarly, when the interest rates are high, people tend to avoid expenses, avoid buying cars, avoid buying houses if they are very high interest rate, especially at the retail level. So in a way, what we are saying is the overall growth of the economy gets impacted as the interest rates are high. So it does not really matter what is the interest rate right now, but what really matters is where we are in the cycle. Are we towards the highest end or at the lowest level? That we are still, even with the increase, we are still at the lowest level of the interest rate we have seen. What does this mean? This basically means that unless and until we start moving the interest rate where it starts hurting the economy, we are good to go. And why would a central bank do all this? For simple reason. When the interest rates are low, there is a certain stimulation in the economy. That stimulation in the economy causes inflation. Inflation in simple terms is basically a price increase. This is often linked with the commodity cycle when the commodities such as steel, oil, aluminium, copper, cement, and so on, these things start increasing in prices. There is a trickle down impact on each and every aspect of the economy. Even buying your consumer durables will get more expensive. As you can see that we are experiencing a supply shock on one side because there is a supply constraint due to all this pandemic related issue. Ukraine-Russia war, all these things are causing supply chain restrictions. So the recent increase is basically to taper down the inflation in the economy. As a central bank, it's a wise decision. And my 2 cents is, unlike US, UK, and a whole lot of other developed countries where there has been a free money given to people. Indian economy, the stimulation even during pandemic was restricted to a certain strata of society. In general, people have actually made money and that may cause liquidity, but from a standpoint of reforms and fiscal stimulus, the stimulus has been limited to a certain segment of society. So we will see as things unleash, but my sense, looking at the data that in the US we are looking at a 40-year high inflation and so on, I have my reservation that in India we will see something of similar nature. We will definitely see increased inflation and we are already seeing that, but I do not expect it to be a 40-year or a 50-year high. I have my reservation around that. So let's reflect on each and every component of the portfolio. What interest rate increase means for these categories. So the first is equity. An increase in interest rate will cause increase in cost of borrowing. The price of equity is bound to fall. Similarly, when the pandemic started, we saw an increase in equity because the interest rates were falling. Now with the interest rate rise, the cost of borrowing increases and equity will face. This is the time to build equity for the next 3 to 5 year period. I think there are a lot of opportunities that are emerging with the correction in the market. And as these corrections, if they go deep, the opportunities are even bigger. But even as we speak, there are massive opportunities. High quality companies will always outshine low quality. In the last 2 years, we have seen low quality companies doing well. I do not expect that momentum to continue and there will be more reasonableness in equity markets. You have to continue with your SIPs, you have to continue with your investments and your overall asset allocation bases your goals. So do not get panicked with the recent correction. However, you can use the recent correction to enter into the market. It will pay you good returns as we progress over the next 3 to 5 years. I still hold India's growth momentum intact. I'm referring to the GDP here, which basically means that we will continue to be amongst top nations in the world with the highest GDP, and that will translate to a whole lot of money in the economy and profitability for companies. We are in a long-term bull run, at least over 3 to 5 years, and these corrections are actually good opportunities for any reasonable investor to allocate and see the money grow. Now we move to debt. A lot of people have complained that their FDs are not paying a high return, especially when the pandemic started. Now they will see that the FD rates will continue to increase, which may give you an impression that FD rate is great, but at the end it is linked with the inflation in the economy, which basically means that the inflation is also increasing. So in real terms, I do not see that you will have any change in this bucket. If you are invested in, say, fixed deposits or short-term investments, say liquid funds or money market, you will be all right. There may be a couple of days in short-term debt fund and liquid fund that may see some bit of correction because as the interest rates increase, short-term debt fund NAV may get corrected for the time being. But if you give like a month or two, it should see some moderation there. And as we progress, even those interest rates will continue to increase. In real terms, nothing changes. Avoid medium term and long term debt instruments because there will be a massive correction in NAV over the next 18 to 24 months. Because as the interest rates increase, longer term bonds will see correction in the price. Gold is an international commodity usually driven by what the world fears. I don't think so the fear is there the way we saw during pandemic. So our fear related to the general economy and world economy has subdued quite a lot now. Things are more or less back to normal. I do not see major fluctuation in the gold side. Gold prices increase when there is fear. So if you see fear related to war, you fear related to economic growth, you see gold prices increase. But with the recent trends that we see, inflation mounting and growth momentum picking up, I have my reservation that gold prices will move a lot from here. The next category, and an important category for Indians, is real estate. We have already seen a lot of momentum in real estate market, and we have not seen the momentum over the last 10 odd years. The last momentum, probably the peak we saw was in 2012 or something. So from then to now, I think we have not seen a whole lot of real estate movement. Now it has started. And what does this interest rate mean for real estate? A lot of people have this point of view that as interest rates rise, home loan rates increase, and that will reduce real estate demand. Well, it may reduce for a very small bracket of the economy, but overall, the way I would like to see this is interest rate increase due to inflation will often cause increase in the rentals. And if we were to assume, say, 3.5% rental yield in Bombay, or 2.6%, let's say, in a city that I stay in, Gurgaon, if there is an increase in real estate rentals, that basically mean that we may see increase in the real estate prices also. The value of the property may also increase. Chances are that since we have just started with the momentum, maybe with the recent increase in interest rate and over the next 3-4 months, it is subdued. The demand is not that much there, but I do not expect a long-term trend changing from here on. I do expect real estate to do all right. I do not expect real estate to be facing any heat, because rental yields are a great hedge against inflation. And if we are looking at a higher inflation, chances are rentals would increase, and if rental yields are increasing, the value is bound to adjust to that yield, because on an average, yields will continue to hold the way they have held over the last 10 years, 20 years. These trends, at least in India, have not changed. So out of all these 4 categories, I feel high quality equity will continue to do well. Debt, avoid long term and medium term. Gold, I do not expect a whole lot of change. Real estate rentals will increase. My sense says that the value of real estate should also increase over the next 2 to 3 years, and it may be a good time to evaluate real estate. One point that I want to make here is I'm referring to residential real estate. We've already seen momentum on the commercial real estate that will continue to increase, because now offices are opening up, companies are asking employees to come back to office. So we are not seeing the trend of work from home as a very sustainable trend. Maybe for a very minute percentage of workforce it may be applicable, but not as a general trend for the society. I do not envisage that for commercial real estate. So commercial real estate will continue to do well. Real estate will continue to beat the inflation at 7%. So real estate, especially apartments, will continue to meet the inflation trends in the economy. If you are invested in land, there might be further escalation in prices over the next 2-3 years. We have already seen in land almost 50 to 100% jump over the last 1 year. From here on, I do not expect that trend to just pause just because interest rates have increased. So overall, I am positive on equity, high quality. I am positive on real estate. I've always maintained a very short-term positions in debt just to park money. So I'm not concerned about, the recent changes that RBI has done. And gold, I've always been little reserved when it comes to gold, because prices are not in our control. We can't see the trends. We can just see if there is too much fear in global economy, gold can be a great hedge. So overall, I feel that in today's context, as interest rates have started increasing, you should be able to structure your portfolio accordingly. Any reasonable person would not be carried away with the trends. The whole idea of understanding these cycles is to make wise decisions and not speculative decisions. I hope you like the video. Thank you for watching.